not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable.
I think we are headed for a collision of some kind or other, and I think the sooner we start managing for some slowdown, the better we're going to do. I think Chairman Powell was way late to come to that recognition, but he now has that recognition, and he should be supported in that.
The pace of job growth is cooling while still powering our recovery forward. Wage growth for workers remains solid, down from the historic high pace months ago, but still growing for workers who deserve a raise. And this is the progress we need to see.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. Broad-based bearishness. European stocks follow Asia into the red after strong U.S. jobs data solidified bets on a jumbo rate hike from the Fed. Golden Week tarnished. Chinese markets reopen in the red, weighed down by concerns over global interest rates, COVID, and fresh U.S. curbs on tech. Plus, explosions hit cities across Ukraine after Vladimir Putin accuses Kyiv of carrying out Saturday's attack on a key bridge link to Crimea. Well, it's a market just so far away from that pivot narrative. It is now far in the distance, and it is a market that continues to sink after the losses on Friday, with unemployment staying at the lowest in quite a few decades. You're looking at S&P 500 futures, which continue to fall down 4%. This as we see the world's global financial chiefs gather in Washington for the IMF meeting. Will there be even more pressure to the Fed to reverse course, considering the reverberations we've seen it had across the world with a strong dollar and a bond market in pain? Now, speaking of which, of a bond market in pain, we're going to get more into depth about this, but just want to point out the Bank of England announcing this morning that they're doing more to backstop this market, be it a repo facility that they're extending out, but beyond the Friday deadline, and having larger auctions. It's a calm market so far. We did have gains in sterling this morning, flipped to losses, but not too severely, and a steady bond market as well. We're actually looking at yields higher by about 3 basis points. Also, just quickly want to point out Hong Kong tech chip makers getting decimated, whether it was in the U.S. session last week because of higher rates. Today, it's about the U.S. putting fresh curbs on on U.S. chip technology being shipped over to China. The concern there is that could have profitability for the Chinese chip sector, according to Bloomberg Intelligence. So that's the view across the globe. Let's zero in on Europe because it does look to be, again, a day of red. Now, it varies depending on the region. For example, some of the utility makers in here, those are under pain. There was an FT report that the UK may be looking at capping profit of renewable energy sources. So utilities, one of the worst performing. The FTSE Mid, that's down about 0.5%. DAX not doing as poorly, down 0.25%. And the FTSE 100 down about 0.7%, despite the fact Goldman Sachs pointing out that corporate Britain has been on a buying spree, the biggest bout of buybacks this year on record. Well, let's stick with that UK story. I mentioned it. The Bank of England stepping up its pressure to support market functioning as its emergency gilt buying measures enter their final week. Now, the UK central bank said it will increase the size of its buying operations for the next 5 days to a maximum of £10 billion. That's up from £5 billion previously. Let's dig into it. We're joined now by Altaf Kazem, head of EMEA investment strategy and research at State Street Global Advisors, and our markets editor, Christine Aquino. Altaf, Christine, thank you both so much for joining. Christine, I want to kick it off with you. Can you just explain what the BOE has done here?
Well, in essence, Danny, this is a way for the BOE to support the bond market in a more targeted way, particularly after we saw really the pension market really getting hit by the losses in bond markets over the last couple of weeks. Now, initially, the response of the BOE to that was to just step in with emergency bond purchases. But we know that that puts the BOE in a very awkward position because they really want to be getting away from those bond purchases, right? This is the whole process of the policy normalization that they've been embarking on. They're doing rate hikes. They want to tighten policy. And so the last last thing that they want to be doing is stepping back into the bond market and buying them. And so now what we got from the BOE this morning is essentially a way for them to provide targeted support, particularly for the pension funds that do liability-driven investments without kind of just outright buying bonds. So in a way, it's kind of getting them away from that awkward position and helping them kind of continue their policy tightening process.
Is it enough, Altaf? Is this enough to calm the market?
I think it is. I mean, I think, like Christine said, what the Bank of England needs to do is kind of draw a line under things, make the market feel confident that they've got the back of the pension funds, but not make it seem like it's an open-ended promise to keep buying gilts. So I think they've done enough. Time will tell if there's more instability in the pension funds, but I think for now this will work.
It works just on a practical level, but what about when it comes to credibility of the Bank of England? Do they face a crisis of credibility?
I don't think the Bank of England itself faces a crisis of credibility. I think the market viewed what they did as pretty credible. I think the government, on the other hand, is facing something like that, and that will have to be addressed in the next few weeks.
It is interesting because this is coming as the IMF is meeting, right? All the chiefs gathering in D.C. And Christine, it does feel like this theme of, monetary policy and fiscal policy being at loggerheads. To what degree is this a UK problem versus a wider global economic problem?
Well, to some extent, it is something that a lot of governments and central banks are facing at the moment. This kind of how do we really align fiscal and monetary policy at a time like this when inflation is out of control, but then you also have a lot of consumers very, very worried about a recession. But in the UK, I think it's particularly interesting because what we saw from the government in terms of the mini budget really put fiscal policy at a much bigger loggerhead, as you mentioned, against monetary policy than perhaps other G7 nations. And that is precisely what markets reacted really so negatively to. The fact that monetary policy on the one hand is hoping to rein in inflation, but then you have fiscal measures that kind of seemingly go against that goal. And so it's going to be interesting to see what sort of reception Kwasi Kwarteng is going to have at the IMF meetings this week at the backdrop of, given that this is the backdrop of the UK at the moment.
Yeah, to be a fly on the wall. Not just for that, but I would love to know what the calls between Kwasi Kwarteng and Andrew Bailey are like every day. I'm sure there might be a little bit of tension in there. But to that point, I mean, can the BOE really start QT on October 31st, given everything that's happened over the past few weeks?
I think it's really unlikely. I think with the way that the pound has fallen, that gilt yields have gone up, the prospects of it getting into kind of full-fledged QT, getting rid of bonds from its balance sheet when it's just spent a couple of weeks buying them to calm the market down, I think that's really unlikely, and I think we'll see an announcement of a delay of that program.
What do you think? A delay? Is that possible?
Yeah, I mean, we are starting to see kind of the narrative and uncertainty around this QT process. And I think, what the BOE has done, they have maintained the flexibility over what they're going to be doing, right? They never actually have definitively said, we're definitely going to start it at the end of this month. And so I think that kind of buys them some room to kind of say, you know what, given the market conditions, perhaps this is something that we can table for a little bit later. But at the same time, I think markets will look for the BOE to eventually signal when they're going to start that process. And so I guess it would be quite interesting to see what markets are prioritizing at this point, kind of seeing the BOE carry on with that QT policy normalization process as they've carved it out initially, or would they prefer the BOE to kind of have more firepower to respond short term to some of the acute stresses in the market at the moment?
How do you see that division between this ability to jump in, make short-term decisions to help alleviate the stress versus, dealing with inflation, hiking interest rates?
Yeah. I mean, the UK is in a very tight spot. It's got the tightest labour market in the developed world because of Brexit-induced labour supply shortages. It's got a currency that's weakening even as bond yields are going up. So the Bank of England is in a very tight spot. Like I said, it did the right thing, we think, by protecting the pension funds at very short notice. But it's going to have to walk that tightrope eventually, and eventually it's going to have to stop buying those bonds and start going for QT.
And who's going to buy those bonds when they're gone?
I mean, there's still a bit of demand, I think, from overseas investors. I think a lot of investors are starting to nibble at sterling assets with the currency being so cheap. That applies across the board, fixed income, property, even equities, I think, are starting to see a bid now. So there is value in the UK market. It's just a question if that value will be destroyed by political risk.
Yeah, and Christine, I want to get one final one in from you before you leave us. I mean, dibbling in, stepping in, I don't know, Christine. But anyway, stepping into the bond market, looking for higher yields, finally buying. I want to expand this beyond just the UK, but yields in general finally look attractive. Is Tina dead? Is it now Tia? There is an alternative?
Well, I mean, the bond bulls would like to have you believe that that is the case at the moment. I mean, we have seen over the weekend, Bill Gross aligning with his former PIMCO colleagues and saying that bond yields are attractive now. It's time to step in. I just wonder whether that is something that would make sense 6 months down the line, you know, because right now we're still kind of hearing from the Fed essentially doubling down on their message that no, tightening is going to continue. This pivot narrative doesn't make sense at all at this point in time. But I'd say 6 months from now, because that would be right around the time when markets at least are pricing for the peak of the Fed funds rate to be hit. And so it would make more sense to be a bond bull at that time versus now. But certainly, you know, this is what markets do, right? They front run a lot of these themes way ahead of when it actually comes to fruition. And so I think, you know, this idea of higher yields finally reaching a point where it's become attractive to investors does carry a lot of water as an idea. It just depends on the timing, as always.
Altaf, I know you have thoughts on this. You stay there. We're going to go to break, but we got to talk Fed pivot next. I'm sure we will get very thoroughly into it. Altaf Kassam, head of EMEA strategy and research at State Street Global Advisors, is going to stick with us. And thanks, as always, to our very own Christina Aquino. Now, coming up, the latest jobs data out of the U.S. reaffirmed traders' bets on another big rate hike next month. Now the focus turns to inflation data due this week. It's CPI week, folks. That U.S. outlook is up next. This is Bloomberg.
I think we are headed for a collision of some kind or other, and we've just got to manage that collision carefully. And I think the sooner we start managing for some slowdown, the better we're going to do. I think Chairman Powell was way late to come to that recognition, but he now has that recognition, and he should be supported in that.
Former U.S. Treasury Secretary Larry Summers there on the outlook for the U.S. economy. Still with us to discuss that outlook, Altaf Kassam, head of EMEA investment strategy and research at State Street Global Advisors. Now, Altaf, we just finished before the commercial break talking about UK yields, that it looks like some people are starting to jump back in. Valuations are cheap enough. Can the same be said with U.S. Treasuries?
I mean, I think U.S. Treasuries right now, given the yield, look very attractive to a lot of investors, given the strength of the dollar. They've been a really great performing asset in terms of the income they're providing. But I think you're going to have to expect more capital losses as rates continue to rise. So it might not be the time, if you want to time it perfectly, to jump back into U.S. Treasuries. But I think if you're willing to wear some capital losses over the short term, it might be a good time for a patient long-term investor there.
Is there a level that they become just too attractive, you can't resist? And are we close to that level, if so?
Yeah, this isn't the answer you're looking for, but I think the level they become attractive is when we're sure that inflation has turned.
Okay, fair.
So then we feel much more confident on the pivot, and then it is the time to buy. Obviously, you'll only know that when you look backwards, but I think missing out on the first, say, couple of months of a bond market rally, a genuine bond market rally, is a price worth paying to not get a burnt in the short term.
Well, let me complicate that even further in the interest of not having anything clear-cut, because we live in a world of gray. Even if we start to get indication that inflation is turning, can we be sure that the Fed will turn too? In other words, does peak inflation necessarily mean peak hawkishness?
I mean, the Fed has promised to be data-driven and not use forward guidance, in other words, to scrutinize every data point, which is why we see so much volatility in the market, why everyone's focused on the next print. But at the same time, unfortunately, the effect of rate rises have a lag. So even if the Fed does reach peak hawkishness soon after inflation peaks, the effect of the rate rises they've already made will still be percolating through the economy for, say, another 6 months.
You say that, and they've said that, you know, they're data dependent, but we've still heard from many Fed officials, Williams being the latest, saying we're going to 4.5%. I mean, that sounds like a forecast to me. Yeah,
that does sound a lot like forward guidance. So maybe he's just, you know, referring to the dot plots, the summary of economic projections, the long-term rate. Maybe he's just trying to do his own version of whatever it takes and talk the market into the Fed's point of view. But if they truly are data-driven, they will keep an eye on, I guess, the inflation numbers that are coming up on Thursday for a start.
How does this dynamic play into the credit cycle? Because at the moment, it is really just an issue of interest rate risk. At what point does that morph into credit risk?
Yeah, I mean, you've been talking about earnings, and I think that is the next thing that the market has to focus on. How much corporate earnings are being hurt by interest rate rises, and how much corporations are able to pass on the effect of higher inflation. Both of those will feed into corporate credit, and that's where we'll start to get an inkling of whether this is going to start causing distress and defaults. We haven't seen it yet, but it's something that we're keeping a very sharp eye on.
Altaf, I want to point out, I know we were talking about the UK earlier, but I just want to go back to it because I'm seeing some pretty substantial moves. 30-year yields taking the brunt of the beating right now. Yields up by 14 basis points. Front end not as bad, 8 basis points when it comes to the 2-year. But it does look like a market that's starting to test the BOE again, even though they've come out with this idea that they're backstopping the market even further. I mean, you can see it there. So 14 basis point move, even though the BOE has come out and tried to calm markets. Does this portend anything for you for what happens after this week when the training wheels are off?
No, it does worry me, and the fact that this is a huge market that appears to have a bit of dysfunction is definitely worrying. We're going to see mistakes. We're going to see things break. This might be the first example, so it really will be a test of the Bank of England for sure.
What does it mean in a world where you're looking at these assets, 30-year yields in the UK, even treasuries to some extent that have been very volatile, an asset class where portfolios revolve around the fact that they're calm, that volatility is low? What difference does it make, just the volatility aspect of this?
It makes a huge difference because, like you say, as an asset allocation kind of constructor myself, I relied for 10 years, 20 years on bonds being smoothing out equities. I can't rely on that anymore. That equity bond correlation has gone positive, and I don't think it's going to come down anytime soon. So you have to look for other sources of diversification. You have to get more defensive in your equities, and just having a 60-40 portfolio and putting it in the top drawer and locking it away, it's not going to work.
Okay, well, we'll end with that sage yet depressing wisdom there. Altaf, thank you so much for joining us this morning, playing ball with the breaking moves in these bond markets. Altaf Kassam, head of EMEA investment strategy and research at State Street Global Advisors. Coming up on the program, rockets hit the center of Kyiv for the first time in months, following an attack on a key bridge linking Russia with Crimea. More in a moment. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to the Bloomberg First Word News now, and with that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny. Missiles have struck Kyiv and other Ukrainian cities 2 days after an attack on a key bridge to Crimea that Russian President Vladimir Putin has blamed on Ukraine. Kyiv has not officially claimed responsibility for the blast, although it has celebrated the explosion with a new postage stamp. Here in the UK, the Prime Minister Liz Truss is planning to speak directly to MPs in a Conservative Party this week as she seeks to rescue her premiership. Meanwhile, the Bank of England has this morning announced additional measures to support market functioning. The bank will increase the size of its bond buying operations for the next 5 days to a maximum of £10 billion, double its previous level. Now, the French President Emmanuel Macron has urged citizens not to panic and to act responsibly after a refinery strike left petrol stations with no fuel in some regions. The Transport Minister says the government may release additional strategic fuel stocks in a bid to alleviate the tight market. A labour strike has hit the country's two biggest refineries, affecting almost 2/3 of the nation's capacity. And China stepping up its efforts to contain COVID outbreaks ahead of the party congress. Nearly 1,900 cases were reported yesterday, the highest level in almost 2 months, fueling concerns about widening lockdowns rippling across the financial hub of Shanghai. Meanwhile, PMI data showed China's services activity contracted in September for the first time in 4 months as lockdowns dampened consumer spending. Global news 24 hours a day on air and on Bloomberg QuickTake, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Danny.
Leanne, thank you so much. Leanne Gerrans there. Now, we continue to see pressure in this UK market. It is a bond market where the pressure is back on with a BOE who attempted this morning to get ahead of any market pressure, considering that their bond buying program will end on Friday. So what have they done? They've doubled the amount of daily purchases they can make in the auctions, and they've also announced a temporary expanded collateral repo facility. The hope is with that they can stem some of the damage from this LDI, relieve some of the liquidity issues, but still it is a long end that is selling off. We're up about 13 basis points here, still off the high, which was over 5%, but still, it is clear that this market is willing to test the BOE. Yes, the training wheels are coming off. Yes, they're trying to do more to step in and stop some of the hurt. However, the total purchases were only £5 billion. So is the risk really washed out of this market when it comes to LDIs and UK pensions? Now, coming up, we're going to talk about Credit Suisse, their securitized products unit, drawing interest of some of the big names. We'll discuss that next. This is Bloomberg. Broad-based bearishness. European stocks follow Asia into the red after strong U.S. jobs data solidified bets on a jumbo rate hike from the Fed. Golden Week tarnished. Chinese markets reopen in the red, weighed down by concerns over global interest rates, COVID, and fresh U.S. curbs on tech. Plus, multiple fatalities are reported as rockets hit Kyiv for the first time in months. It follows Saturday's attack on a key bridge linked to Crimea, which Putin blames on Ukraine. Good morning. Happy Monday. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Now, Bloomberg understands that PIMCO and an investor group that includes Central Partners are among the shortlist of bidders for Credit Suisse's securitized products business. A deal for this part of the business is a key pillar of the Swiss lender's plan to downsize its investment bank, and it would also help to pay for restructuring. Bloomberg's Tom Metcalf is with us to help us dig through all of it. So, Tom, I mean, another twist and turn of the Credit Suisse story. Where do we stand? What's the latest state of play?
Yeah, after last week's very much a wild week in the market with Credit Suisse, it started on sort of more positive foot with this news that, you know, there are interested parties in this securitized products group. And as you just said, it's really a key element of their hopes to sort of stabilize the bank and move forward. And really the questions are, you know, what happens next, both for this section, but the other options that the bank are looking at.
So what options then are we hearing from the bank to raise money? What are they dabbling with?
Yeah, so alongside the securitized products thing, the other thing would be perhaps spinning out sort of the advisory arm of the investment bank, even under the name First Boston, which it was sort of retired a few years ago. And then also, these are seen as maybe perhaps less likely, perhaps an IPO of the Swiss unit, or even more dramatically, perhaps just trying a straightforward capital raise. But the problem with that, of course, is that with the share price at these record lows, it's going to be a very, very expensive way of doing it. So both those options are sort of seen as much less favorable.
Well, they've given themselves pretty much until October 27th to announce what sort of restructuring, what shape the bank will take from here on out. Is this a market that's willing to let them go, willing to let them formulate this idea until the 27th?
Yeah, it's fascinating. Look, last week you saw the share price fall 12%, and by the end of the week it was up 15%. So it's sort of very turbulent times right now. I think, that is everything we're hearing is it's all going to build up to this sort of big event, this sort of strategy briefing to investors on the 27th. And there'll be a lot of great data coming out of that as well. You'll see sort of client inflows and outflows. So obviously Credit Suisse will be wanting to tell a particular story to its investors there, and then the question is how the market reacts.
Okay, Tom, thank you very much. Bloomberg's Tom Metcalf there. Now let's change gears a little bit and dive into the UK banking story. We're joined now by Benjamin Toms, Director of Equity Research for UK Banks at RBC Capital Markets. Ben, thanks so much for joining us. So immediately this morning, we get the BOE trying to get ahead of any market sell-off with the sort of training wheels falling off on Friday. They're going to up the amount of bonds they're purchasing, and at the same time, they're putting in this longer facility, this longer repo facility for LDIs to help smooth out liquidity issues. Is it enough? Are there still UK banks who are potentially exposed to liquidity problems when it comes to pensions selling assets?
I think you can split the banks into two, really. There are some that are quite exposed to movements in the rate curve, but the others we think are pretty well hedged, and for the domestic UK, it shouldn't be too much of an issue.
How big is that split? In other words, should we be worried?
No, I don't. To be honest, this quarter you're going to have some weird movements going through OCI for a bank like HSBC because of movements in the rate curve. But for the majority of the banks, I think it should be okay.
Of course, the other reaction to this potential inflation moving on, less tax revenue, is a BOE that's had to hike rates more. Obviously, the impact there is on the mortgage market. You write, Ben, the squeeze is coming. What does that squeeze look like?
Yeah, I think it depends also what type of customer you are. So you may know that the banks in the UK issue mortgages of different kind of tenures, and 15 to 20% will roll over straight away. If you've got one of those mortgages, you'll be seeing higher rates today. Other customers, it's split between 2 and 5 year products mostly, and so you have some time there if you are one of those customers. But for anyone rolling over this year, you've got a big kind of squeeze coming, particularly when you add into the fact that food costs are going up and energy costs are going up at the same time.
Yeah, because we debate this idea on the show very frequently. Can the BOE hike as much as markets are saying because of the damage it will do to the consumer? Is there a level of rates at which you say the damage is immense, the damage is very bad?
I think when we've heard UK banks talk previously, they've talked about rates being over 4% as the real problem, and that's when they'll start seeing asset quality problems. On the other side of it, you've got unemployment, which is staying very low at the moment, and the banks would point out that whilst unemployment stays pretty low, that tends to be pretty good for cost of risk and impairment at UK banks. I
mean, it's quite the mix. Things that are clearly beneficial, things that are extremely worrying. So what is your outlook when it comes to this last quarter of the year?
Yeah, I think for the next couple of quarters, you're going to get banks produce very good results. Deposit betas, which is another way of saying the amount that rates get passed on to the consumer, seem to be staying quite low. And whilst that's the case, NII is going to be very good for the UK banks. However, once you get into next year, I think you've got two problems that are going to come through. So 50% of banks' cost bases are salaries, and you've got high inflation and wage inflation, which is going to flow through there. And then you've got a debate around impairments. The market at the moment is pricing in lower than through the cycle cost of risk for next year. We're a little bit more bearish, we think, above through the cycle, mainly because of the work we've done around mortgages.
Okay, really interesting stuff to unpack there. In terms of remuneration, have banks started to slow down? Have they started to cut staff? We've certainly seen that happen in the US. Same thing happening here?
Well, firstly, in terms of pay, we saw top-ups at the half year where banks increased salary rises that didn't come through in January of last year. In terms of headcount reductions, we've seen a few bits trickle through, but I expect the deluge is probably still to come.
Okay, and the other part of that, the impairments, how much do you expect that they will need to set aside?
The banks?
Yes,
well, you know, if you speak to the banks, they will tell you that they come into this potential recession next year with coverage levels being high. They've got COVID-19 impairments still in place. LTVs are pretty low and unemployment's pretty low, and credit card mix is also quite low. So all that adds together to say that cost of risk should be okay. But when you look at the sheer amount of pain that the consumer is going to get next year in terms of mortgage payments, it's difficult to see that cost of risks won't go at least 5 or 10 basis points above through the cycle levels. So
consumers, potentially those cracks are showing, but on the corporate banking and specifically corporate lending side, it's been really fascinating to watch a market that essentially seems frozen, that banks are just really unwilling to lend right now, unwilling to bring these packages to market because, you know, the amount of concessions they have to take are just so massively high right now. What does deal making look like in the UK for these banks? Is this still a market that is frozen considering the risks at this moment and the widening credit spreads?
Just to bring it back to mortgages for a second,
yeah,
I think you know banks have pulled mortgage products,
right? And
I think they probably get a hard time in the press about the size that rates are for new mortgage holders. But if you look at the spread data from last quarter, banks are making less money on mortgages than they have done for years and years and years. So it's worth remembering that their funding costs are going up at the same time. And then in terms of the kind of corporate element, I think, that, as you mentioned at the beginning, the Bank of England and government policy at the moment is creating an uncertain environment. And whilst that uncertainty exists, I think banks will hold back from kind of putting their balance sheet to work.
And, you know, in terms of net interest income, because last month when we had banks reporting it, it was obviously, you know, a better reporting season for them. Is it the pace of gains in interest rates that is the issue here? Because obviously, just in general, higher interest rates means better net interest income.
Yeah, you're right. There generally, for most banks, is a correlation between higher rates and better net interest income. I think the key determinant here is deposit betas and where that really sits. But the speed at which it happens makes a big difference for banks, how they price their mortgages. If it happens too quick, they can't get the product out quick enough, and they then start losing spread on the product they have that's out there. So there will be a period of catch-up for a couple of months to come, and that's why we see mortgage rates about 6% at the moment. They could trend higher.
Certainly no boring times for you ahead. Ben, thank you so much for joining us. Benjamin Toms there, Director of Equity Research for UK Banks at RBC Capital Markets. Now, coming up on the program, several blasts hit the center of Kyiv just days after an attack on a key bridge linking Russia with Crimea. More on that in just a moment. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Good morning, Danny. Chinese chip stocks have slumped after fresh U.S. restrictions on access to technology added to a disappointing start to the earnings season. A Chinese Foreign Ministry spokesman has criticized the curbs as unfair and said they will also hurt the interests of U.S. companies. Recent American measures seek to stop China's drive to develop its own chip industry and advance military capabilities. Renault is said to be open to cutting its stake in Nissan. Sources say the two companies are ramping up talks over the French car maker's plan to split its electric car and combustion engine assets due in early November. We are told Nissan is pressing Renault to reduce its stake from over 40% to 15%, which would bring it level with its own holding. And Chinese food delivery giant Meituan is said to be considering expanding into international markets as domestic growth slows. Bloomberg understands the company will first attempt to break into the Hong Kong market, though plans are still at the preliminary stage. And that's your Bloomberg Business Flash. Danny.
All right, Leanne, thank you very much. Leanne Gerrans here in London. I want to look quickly at markets. We are looking at a 30-year yield, which continues to move higher here in the UK. Yields are up by about 11 basis points. That comes after a BOE, which is really just trying to get ahead of market pressures, considering that the training wheels, the continued bond buying ends on Friday, still not the best reaction. From the UK now to Russia and Ukraine, where central Kyiv has been hit by explosions for the first time in months, just days after an attack on a key bridge that links Crimea with Russia, a bridge that Russian President Vladimir Putin blamed the attack on Ukraine. Now, Kyiv's mayor said that Russian missiles have hit critical infrastructure in the city. For more, let's bring in Bloomberg senior reporter for international affairs, Mark Champion. So, Mark, we have Putin calling a meeting with his Security Council. What do we expect from it?
Yes, I think the shape of the retaliation is already showing. It's not just Kiev, but probably the largest set of missile attacks on cities across Ukraine since the war began. The targeting is very clearly on civilian targets, civilian infrastructure, Kiev's Central Park, a pedestrian bridge. These are, very clearly, often in the past, residential apartment buildings were hit, but they were somewhere in the vicinity of military targets. In this case, it seems clear that these are, deliberately targeted civilian assets and infrastructure. This seems to be the shape of the retaliation. We'll have that Security Council meeting, so this may just be the beginning. There could be further escalation.
Well, in the past, we have seen Ukraine attack arms depots and other transport infrastructure in Russia itself. So why is this bridge different, Mark?
Well, I think there are two aspects to that. One is that it is a very important piece of infrastructure for the Russian military campaign. This is the road and rail bridge that connects Russia to Crimea, which was annexed from Ukraine in 2014. And across that road and rail bridge comes all the military equipment, fuel, etc., for the Russian forces that are fighting in the southern part of Ukraine. So it's very important in that sense. But secondly, this was a personal project of President Putin. It's a 19-kilometer bridge, a very significant, piece of construction, and it was built after 2014 to lock Crimea into Russia. So both symbolically, personally, it's an embarrassment to President Putin, and it's an embarrassment for the Russian security services that it could have been executed, because it doesn't look as though this was a long-range missile. It looks rather that it was a truck bomb.
And despite what Russia just perceives as escalations, despite Russia, which is deploying more troops, stepping things up, we still see Ukraine able to make headway. What's been making this possible?
Well, I mean, there's a sort of range of factors that go all the way from, NATO training to the enormous number of, quite modern weapons that Ukraine is being supplied by the West. But there's a kind of critical one, which is much more of a soft issue, but that is that simply that the Ukrainians have since 2014 learned to fight in a different way. They've had 8 years in the trenches to cycle almost, as many as 500,000 troops through those trenches. So all of those soldiers gained experience. The officers who, came up through the ranks during that period are now at the very top of the Ukrainian command. A lot of this, the Russians didn't have, and the Ukrainians at the same time decided to have develop a really devolved style of command, which allows them to be much more nimble, make decisions more quickly, and whereas Russia still, is organized and fights very much as it did during the Soviet days.
Okay, Mark, thank you very much. That's Bloomberg senior reporter for international affairs, Mark Champion. Coming up, under pressure, Goldman Sachs shakes up its consumer banking plans. It's the big take. We'll discuss it next. This is Bloomberg.
We need to continue to bring down the inflationary pressures that people have. Certainly, what OPEC made the decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, we were talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing 263,000 people going to work today. This month, I should say, last month, we're still seeing those numbers going on. So I think that that's something that is important, that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month, I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years, healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their health care by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
Labor Secretary Marty Walsh there speaking with Bloomberg's Jonathan Ferro. Now, a panel of German experts have just released a new proposal for gas subsidies. It would be subsidizing 70 to 80% of gas consumption. This plan would be broken down into two parts. It would be 80% subsidies for German private gas consumption, 70% when it comes to industrial. This would be part of a 200 billion euro aid package. So again, this is just subsidizing gas consumption. It does not go into detail about demand destruction, which of course we know would be necessary in order to get these prices into check. So again, 70 to 80% of gas consumption, that is the proposal for subsidies here. Now let's switch gears a little bit and talk about today's big take. And it's all about Goldman Sachs. Under pressure, it's dialing down its aspirations for the consumer market. CEO David Solomon is restructuring his consumer plans after cost overruns and missed profit goals. Joining us now is Bloomberg's Charlie Wells. Charlie, how big of a shift is this for Goldman?
This is pretty significant. So for well over half a decade now, Goldman Sachs has really been trying to crack the American retail banking market. We had one executive back in the day saying that he hoped that Americans would see Goldman Sachs as a, quote, lovable teddy bear. We know that Solomon himself got on a plane, as our story details, and tried to sort of come up with some sort of partnership with the celebrity Reese Witherspoon, who was thinking of offering her fans financial services, but dialing back of checking accounts, things like robo-advisory services that were supposed to be intended for a broad audience, but are now going towards wealth management clients, so a lot fewer clients.
What was the sticking point, the thing that made it so difficult for Goldman to get this off the ground?
A couple of things here, right? So first and foremost, it's incredibly expensive to execute retail banking right. So one study shows that it costs about $500 to acquire a new consumer, but then 15% in a year of clients, leave a bank. When you look at Marcus, the retail banking product offered by Goldman, that was supposed to break even this year, but what you see since 2016 is the bank spending $4 billion there. So it's expensive. The technology is really difficult to pull off. It's also just such a competitive marketplace.
Okay, Charlie, thank you very much. That's Bloomberg's Charlie Wells. And of course, you can read the big take going, NI Big Take Go, on your terminal. Well, we continue to watch a euro that weakens. German bonds, some of the gains there starting to peter out with new subsidies being recommended by a panel of experts. The conversation and early edition continues next. This is Bloomberg.
The Fed is on a one-way freight train, and they're moving very quickly.
I think we are headed for a collision of some kind or other, and we've just got to manage that collision carefully.
We are walking a knife's edge difference between the soft and the hard landing.
I think there is still some distortions that can be worked out.
We do expect the market to remain volatile.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The Bank of England expands its emergency support for the UK bond market. The new measures target the pension industry as the existing programme of gilt buying finishes at the end of the week. Chinese semiconductor stocks take a dive. They get hammered after the Biden administration limits their access to American technology. And Russia strikes back. Missiles hit Kiev and other Ukrainian cities after Vladimir Putin blames Ukraine for the attack on a key bridge to Crimea. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, in terms of risk appetite, we're still dealing with the after effects of that jobs report from Friday and looking ahead to the inflation print this week.
Absolutely. That inflation print is going to be critical, especially now as it seems that the market has abandoned that pivot narrative for the Federal Reserve. The jobs report really solidifying the idea that they are going to stay hawkish. And that was definitely evident in the Asian session overnight, where stocks broadly were lower, including China, which opened back up after a week-long holiday, and it was a negative reopening. The CSI 300 down about 2.2%. Now, in part, that had to do with the Caixin Services PMI number that is back in contraction territory. But the other big drag is technology stocks, specifically chip makers. After, as Anna mentioned, the U.S. announcing new tech curbs from U.S. technology, export controls tightening, and that weighed on chip stocks really across the board in Asia. One of the big examples being Shanghai Fudan Microelectronics, down 20% just in one day. Now, when it comes to the Chinese yuan as well, the PBOC is still trying to make it stronger, setting a 28th day in a row stronger reference rate, and yet still weaker against the U.S. dollar, as it is a day of broad-based dollar strength this morning. Right now, the offshore yuan trading at 714.61 to the U.S. dollar. And then, of course, following the jobs report of Friday, we saw treasury yields moving up. You saw follow-through of that in the Asia Pacific, including in New Zealand, where the two-year yield moved up about 11 basis points. But, of course, today, Matt, no treasuries trading because it is the Columbus Day holiday.
That's right. And nonetheless, it looks very risk off here because we see a big surge in the Bloomberg Dollar Index. S&P futures off about 0.5%. And of course, we had a terrible close down 2.8% on Friday. But remember, for the week, we were still up about 1.5%. We had gone down to something like 35.85 in the previous week, and we closed at around 36.36 last week. So we are seeing futures off to start the week today, and you're seeing the dollar index come back up. 1344 is the level here, and it's stronger against the pound, it's stronger against the euro, and you saw a real surge in the dollar against other major currencies about an hour ago. NYMEX crude right now is off about 62 cents a barrel, but still up to 92.02. This is another asset that kind of stealth rose during the OPEC cut. It didn't seem like we were seeing a lot of action, but if you look over the last couple of weeks, we're up from about $76, $77 a barrel in 2 weeks to 92.05 on Texas Intermediate. So not a bad rise, although it is bad, of course, if you need that fuel to power not only your vehicles, but also your factories, and that's why it's a headwind for stocks. Bitcoin also down more than 1% right now, 19,267, still holding in that very tight range. But as we get to a week where we're going to focus even more on global central banks raising rates, it's important to watch that. That's not good for the cryptocurrency. Anna, what do you see in Europe?
Yeah, we'll certainly have more on that crypto story, won't we, later on in the programme. This is the picture for Europe there, Matt. Looks negative. Germany actually outperforming, fairly flat performance today. Elsewhere, negativity across this European space. Interesting view of experts in Germany recommending a substantial package of support for users of gas over in the German economy. More on that a little bit later. But broadly speaking, we are negative across European equity markets. Let me show you some of the assets that stood out to me today, and we'll start with UK assets. And we've just heard that the UK government says it will announce its medium-term fiscal plan on October the 31st, and you may remember that it was delays to all of the full fiscal details, the full fiscal package, that was one of the reasons we saw a bond sell-off in the UK, in the gilts market. And so as a result, some of that news flow of interest to bond markets. We have, though, seen the 30-year yield spiking this morning, and we have seen a continued sell-off at the 30-year, 4.5% now the yield on the 30-year. The Bank of England confirming its policy, its emergency step-in, will come to an end at the end of this week, but they are adding another policy that will run till November the 10th, which will be specific to the pensions industry, a sort of window where they can place collateral with the Bank of England in exchange for cash, a broader range of collateral, not just gilts. Brent Matt has already talked about Renault, this stock up by more than 4%. The car maker, of course, has a big shareholding in its partner over in Japan, and they have confirmed they're in talks with Nissan that might result in Renault deciding to sell that and, of course, getting a pile of cash in exchange. Credit Suisse in focus, 1.7% higher. There has been talk about selling off a securitized part of this, the securitized products part of this business. PIMCO and others said to be interested, according to our reporting. We have to wait, though, Matt, until nearer the end of October before we get a fuller picture of the restructuring and the reshaping of Credit Suisse.
Yeah, absolutely. I think October 27th is the day. Let's talk about other banks, though. Central that is. The Bank of England stepped up its measures to support market functioning as its emergency gilt buying measures entered their final week. The UK central bank said it will increase the size of its buying operations for the next 5 days to a maximum of $10 billion a day from $5 billion previously. Bloomberg's Danny Berger joins us now for more. So this is actually a massive amount of firepower. Will they use it all, though, considering they haven't used that much so far?
I was going to say, if what they've been doing is any indication, probably not. I mean, their maximum is $5 billion daily, or at least prior to this announcement it was. It's now double that, as you said. They've only used up $5 billion of this. That's all that they've bought from this market. So will this be enough? They're really trying to get ahead of the market, considering that this program is set to end on Friday. There's concerns of the bond market just selling off again, pensions being pushed yet again. There have been a lot of pension experts who have been warning that they haven't had ample time to get back to normal their liquidity buffers. So we have this longer term, at least until November, this temporary expanded collateral repo facility that's supposed to help ease some of those liquidity issues when it comes to LDIs. But we have seen a market that is concerned. After this was announced, we've seen some pain in the UK bond market, and it's yet again being led by the long end. Now, this recent breaking line that the UK is going to announce their fiscal plans and the OBR forecast on October 31st, rather. There is no 33rd of October, 31st. It comes at a time when we're supposed to get QT from the Bank of England. I mean, the timing here is really fascinating, and it is clearly a bond market that's concerned. Long end yields here are up by 10 basis points, Kailey.
All right, Bloomberg's Danny Berger, thank you so much. Yeah, I vote for no months being longer than 31 days. All right, let's turn from the UK to China now. Chinese chip stocks slumped after fresh U.S. curbs on China's access to American technology added to disappointing starts to the earnings season for these companies. Charlotte Yang, our Asia equities reporter, joins us now for more. So, Charlotte, tell us more about how Chinese investors are reacting to the latest measures from the U.S.
Yeah, so the latest U.S. curbs have been a selling trigger for Chinese semiconductor shares today. And just to show you how bad it was, the sector's bellwether stock SMIC has fell by most in 2 months. And also industry watchers are seeing these latest measures as can be a big setback for Chinese semiconductor sector and dragging revenue growth for some companies as well as their technology development. And they say this could also be bad for the global semiconductor sector given the rising geopolitical tensions between China and the U.S.
Okay, so that's the specifics around China-U.S. relations and these chip stocks. What is the broader sentiment for the Chinese stock market as we approach the Communist Party Congress? It kicks off over the weekend, of course, and it's something that only happens once every 5 years.
Yes, and so it's just a really bad Monday for China stock traders who have just returned from the week-long holiday. Their grappling was a slew of weak data from consumption, property, as well as latest COVID lockdowns. So sentiment is really weak now, and people are not adding any positions as we're heading to the Communist Party Congress, and they're just looking to find out more clear signals from where China is going with its COVID zero policies as well as stimulus policies.
All right, Charlotte, thanks very much. Bloomberg Charlotte Yang there talking to us about what's going on in China. Now let's talk about Ukraine. Missiles struck Kiev and other Ukrainian cities earlier today, 2 days after an attack on a key bridge to Crimea. Russian President Vladimir Putin accused Ukraine of committing a terrorist attack aimed at destroying civilian infrastructure. He called a meeting of his Security Council today. Mark Champion, our senior reporter for international affairs, joins us now for more. So, Mark, what do we know about the bridge and the retaliation?
Right. Well, I mean, the bridge was successfully attacked in what looks to have been a truck bombing. That requires, quite a lot of organization and was an embarrassment, really, given that it was such a clear strategic target for the Ukrainians to hit, that the Russian security services weren't able to stop it. So it's also a very sort of personal attack on President Putin. He associated himself very much with the construction of this bridge after annexing Crimea in 2014. He wanted to really integrate it into Russia forever. So to have it, pieces of it dropping into the sea is really a sort of personal affront to him. And, what we're seeing now in Kiev and across the country are missile strikes on a level that we haven't seen before. Kiev hasn't been hit, central Kiev, by missiles on this scale for months at this point. And also the nature of the attacks, these are very clearly directed at civilian targets, a pedestrian bridge, a park, very popular park, these kinds of things. In the past, when residential buildings were hit, oftentimes, they were in the vicinity of military targets so that they might have been hit by mistake. But in this case, there is absolutely no mistaking it, infrastructure and civilian targets.
Now, President Zelensky has been speaking to some European leaders, and he says he will address the emergency G7 meeting about the attacks. What are we expecting from the Russian side then, Mark? It's been fascinating to watch what's going on in Russia, the level of criticism that has been tolerated in Russia of the regime or of military leaders. What happens next?
Right. Well, I mean, there are two things to be said about this. I mean, Putin is coming under criticism within Russia, but it's not necessarily the kind of criticism that Ukraine or the West would like to see. This is coming from the nationalist and ultra-nationalist right in Russia, and they are attacking Putin for not conducting the war with enough vigor. So they're not against the war itself. They're very much in favor of the war, but they are attacking him for being too weak in its pursuit. And they are constantly talking about, the fact that we haven't really started fighting yet with all the resources that we have. They're pressing him to escalate. In some cases, they're, pressing for escalation to a tactical nuclear weapon as well. So not something that we want to see. There's no sign at the moment that Putin is backing down in the face of international criticism. On the contrary, that we will have to wait and see what happens at the Security Council meeting that he called for today.
All right, Bloomberg's Mark Champion with the latest in geopolitics. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And I have to begin with Rivian. After over the weekend, it announced it is recalling 13,000 vehicles because it discovered a minor structural defect. That is nearly all of the EVs that it has delivered thus far. So that is weighing heavily on the stock in pre-market trading, down about 6.5%. And you have another automaker lower as well, Ford. This is after getting downgraded from neutral to sell at UBS. The analysts there talking about how Ford has one of the least attractive risk-reward profiles in the space. As a result, it's down about 4% before the bell. And another stock to note, and this is related to the U.S.-China chip story, is Lam Research. This is, of course, a U.S. maker of the equipment used to make semiconductors. It gets about 31% of its revenue from China, so perhaps those restrictions could hit that portion of its business. And as a result, it is down about 2.6% before the bell, Anna.
Coming up on the program then, Kailey, we'll talk to Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. What is the European strategy at the moment? A lot to say when it comes to the European gas story, the European energy space, and indeed what's going on in UK gilt markets as well. We'll get Karim's view shortly, and we'll discuss the state of crypto with Tim Grant, Galaxy Digital's Head of Europe. He'll join us shortly. Plus, ditching the dream of consumer domination after an expensive push into retail banking. Goldman Sachs is now reeling in its plans. More from today's big take story ahead. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller with Kailey Leinz here in New York, Anna Edwards with us out of London. Now, as we focus in on inflation, of course, energy price is a huge part of that. I'm looking at the week that we had in crude. It's down a little bit today as the dollar rises up, but last week was the strongest week that we've seen in 7 months, with OPEC cutting 2 million barrels of production. At least that's the headline cut figure a day. And even as we are concerned about a decline in demand due to an economy that should be slowing down, at least as central banks around the world raise rates. Eddie Vanderwalt joins us from Bloomberg's Markets Live to talk about what this means and what we should expect going forward. Eddie, are we going to really see a drop in demand?
We may well do. Look, I think, if the world economy heads through a recession, then, absolutely oil demand should fade away. But you know what? I think for me, the big takeaway here is that the long-term story for oil is extremely bullish, because on the one hand you've got OPEC trying to announcing that 2 million barrels a day cut, which isn't even a 2 million barrels a day cut. They don't have that much to cut. At the same time, we're not seeing shale picking up at any way, shape or form, even at this $100 a barrel level. That tells me the supply side just isn't there. It's not there to supply the oil that the world economy needs if this is a short, sharp recession that we see.
And what about the broader energy outlook? Good morning to you, Eddie. For Europe at this point, a difficult winter in store. We heard from an advisory group to the German government this morning recommending the state subsidise as much as 80% of natural gas consumption for households and companies as part of that existing €200 billion package.
Yeah, you know what? The natural gas situation in Europe is extremely interesting. What we've seen over the last few weeks is that the short end, the contracts for near-term delivery have come down significantly. We're talking about a December contract that's down 50%, over the last couple of months. What that tells me is that the market is assuming that perhaps, given mild winter, Europe should have enough supplies. But at the same time, we're seeing the longer end of the curve. So next December's contracts and further out, above where they were a month ago, which tells me that the market says Russian supply is not coming back for next year either.
Eddie, finally, just on a broader macro scale here. Obviously, early last week, we were talking about the possibility of a Fed pivot. The jobs report on Friday seemed to throw a huge bucket of cold water on that. We await inflation later this week. Where are we on that pivot narrative now?
Yeah, absolutely. You know what? I wanted to buy into that pivot narrative. I wanted to be the bull in, I don't know, the China shop. But it's disappointing that particularly the participation rate ticked lower, because, a lot of that narrative is built on the idea, the bullish narrative is built on the idea that workers are going to come back to the economy and, push down the inflation story. And now we saw a little bit of a wage inflation coming down as expected, but the participation rate falling, and I think that's worrying. But really, the big story is CPI as we move towards the end of the week.
Absolutely, CPI, the next data print to really watch after the jobs report from Friday. Eddie, thank you very much. Eddie van der Veld of Bloomberg Markets Live. And for more market analysis from Eddie and the rest of the Markets Live team, MLI Vigo is the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Germany, an advisory group is urging the government to subsidize as much as 80% of natural gas consumption for households and companies early next year. It would be part of a $194 billion aid package. The German government will review the recommendations and issue a decision in the coming weeks. A mega yacht linked to one of Russia's richest men has docked in Hong Kong's harbor. That's led the U.S. to warn the city that assisting sanctioned individuals could threaten its status as a financial hub. The yacht, called Nord, is tied to Alexei Mordashov, who was sanctioned by the EU, U.S., and U.K. following Russia's invasion of Ukraine. Meanwhile, Taiwan's president says there will be no compromise on its sovereignty or democracy. That came hours after China hailed a proposal from Elon Musk that the self-ruled island adopt a Hong Kong-style governance model. Taiwan's president said that Beijing should not make any misjudgment on account of Taiwan's vigorous democratic system. And Allianz chief economic advisor Mohamed El-Erian is blaming the Fed for what he calls the very high risk of a recession. El-Erian told CBS that the U.S. economy is on a bumpy journey to a better destination. But he again warned that the Fed could hurt the economy by slamming on the brakes to fight inflation. And Matt, of course, this is something El-Erian has been sounding the alarm on for some time, the idea that the Fed moved too late and now there's going to be consequences of that delay.
Yeah, exactly. I mean, I think, honestly, this is nothing new. The Fed moved too late a long time ago. They can't really, turn back the clock and do it again. So, they've got to deal with the situation there and now. And Larry Summers said on Friday to David Weston that the only way they can do that is to continue raising rates. And if they break something, we'll have to deal with it when they do.
Yeah, even if it results in financial instability, which ties into what we talked a lot about last week. Coming up on this programme, we'll put these questions to Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. What are the flows tell us right now? What does he see? We will talk to Karim shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Bank of England expands its emergency support for the UK bond market. The new measures target the pension industry as the existing programme of gilt buying finishes at the end of this week. Chinese semiconductor stocks take a dive. They get hammered after the Biden administration limits their access to American technology. And Russia strikes back. Missiles hit Kiev and other Ukrainian cities after Vladimir Putin blames Ukraine for the attack on a key bridge to Crimea. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Matt, risk appetite taking a hit from Friday. That continues to be the vibe this morning in Monday's markets as we gear up for that inflation print later this week.
Yeah, huge drop we saw on Friday. At the end of the session, we were down 2.8% on the S&P. We're off again in terms of futures now, just about 1/3 of 1% so far, 4 hours away from the market open. So a lot could change between now and then, but we got some headwinds, namely a stronger U.S. dollar. The dollar index up 1344, so gaining against most major world currencies, including the pound and the euro. And even though crude is off, it's at a relatively high level, right? This is Tex Intermediate, not Brent. And we're seeing it trade at $91.96 a barrel. So yes, it's down 68 cents, but it had an incredibly strong week last week, the strongest in 7 months. And that also is a headwind for stocks. Bitcoin coming down about 1% right now, 19,286. As the dollar gets stronger against other assets, it's no surprise that you see a little bit of weakness in Bitcoin, but we're still hanging around in that $20,000 range. Kailey, what do you see in terms of pre-market movers?
Well, in addition to Bitcoin and crypto, I know there's one other thing you like talking about, Matt, and that would be cars. So I'm taking a look at all auto stocks in pre-market trading this morning. The first being Rivian, which is, of course, an EV maker. It is recalling 13,000 vehicles after it found a minor structural defect in some of them. But that is almost all of the vehicles it has delivered thus far. So that is weighing heavily on the stock, down about 7% before the bell. Then you also have two movers related to UBS analyst action. UBS cutting shares of Ford to sell, talking about a negative risk reward profile. Ford is down about 4%, and then also UBS downgrading GM to neutral, saying that the strong EV story is unlikely to drive the stock higher in the next 6 to 12 months. So GM is down about 3%. And finally, I added Tesla on here as well. You are seeing the losses compounding after last week. The stock was down 16% last week, and that is falling further this morning, down about 1.5% before the bell, Anna.
I also have a car focus for Matt, Kailey, but we'll come to that in just a moment. We've got Stocks Europe 600 down 0.3. We're not always so nice. Down 0.3 of 1% on the Stocks Europe 600. So picking up on the losses of Friday. Yes, we were down in Europe, but the US was down more. We catch up with them in today's session. Adding into that, of course, weakness in US futures, and that is meaning it's heavy weather for European stocks today. The UK 30-year yield once again in focus. It was above 4.5% earlier on this morning, and it has been ticking up a little bit despite the action that we've seen from the Bank of England at the long end of the gilt curve. But now coming down, it has come down a little bit, and partly at the same time, at least, as that confirmation we got about the fiscal plans and the OBR statement. All of that will come on October 31st, which might come as a welcome relief for the market if it thinks it's still a little bit in the dark as to how those unfunded tax cuts are going to be funded here in the UK. This is Renault then at 31.96 is where it trades, up by 4.2%. They have confirmed they are in talks with their partner over in Japan, that is Nissan, and they could be about to sell their stake in Nissan. So as a result, the stock is higher. And Credit Suisse, their structured products business in focus. It has attracted interest from the likes of PIMCO and others, according to our reporting. And this all coming ahead of a big reveal, Kailey, on October the 27th around their strategy.
Yep, we will be looking forward to that in just a couple of weeks. Meanwhile, this week, Anna, we're looking forward to the kickstarting of earnings season here in the U.S. Some of the big U.S. banks will be reporting starting Friday with J.P. Morgan, setting the stage for an earnings season that our guests are gearing up for. Here's some of what they have told us about how it will impact the market.
Earnings expectations have fallen sharply for the third quarter, we believe that they're going to be better than expected. The official rate now for the third quarter from FactSet is a 2% gain, with several sectors in the negative territory. We think that 2% is too low.
As much as I hear people tell me the consumer's in good shape, they're not. In the U.S., the savings rate's decade low, credit card usage is decade highs, and it's definitely a deceleration.
In the U.S. is nothing that any of us like to write home about, so to speak. Nevertheless, the economy is on a more solid footing than most places, and earnings still look attractive.
The next move lower will be a more realistic assessment of earnings by analysts.
Going into the third quarter earnings season, if we have some positive surprises, the market's looking for good news, I think it'll react.
Joining us now for more is Karim Chedid, BlackRock Head of Investment Strategy for iShares EMEA. Karim, what are you gearing up for this earnings season? How high is the risk heading into it?
Yes, thank you. I mean, you can see that there's some consensus building around earning bar being still too high to clear. And when I look at the earnings season and I look at how analyst downgrades have begun to come through, there could be more to go. You know, we see that earnings expectations are still a tad too positive. And when we think about the inflationary pressure at the level of input costs that are still coming through, we like to focus on sectors that are more resilient to those cost pressures in this earnings season. So looking at the likes of technology and healthcare.
Okay, so there could be a lot of, good morning to you, Karim, there could be a lot of focus on specific parts of supply chains and specific sectors and where margins manage to remain robust. Let me ask you about Europe then in this context. Looking at some of the data that you do, positioning in European equities continues to be extremely short, you say. What does that tell us going into the earnings story? I mean, the geopolitical risks are plain to see.
Yeah, I mean, it tells us that we have seen signs of capitulation when it comes to European equities. Investors have sold the bulk of their positions throughout this year, and we're seeing extreme short positions both in the ETF space as well as the broader fund flows space across ETFs and mutual funds. Very extreme shorts in European equities, which means that European equities are really priced for the worst case scenario. You know, a lot of bad news is already in the price.
Okay, that's interesting. Does that mean there isn't a further leg down on earnings disappointments in Europe, but there might be elsewhere?
Well, that's where it gets interesting. When you look at the earnings estimates for Europe, they're still too positive. In fact, they're still more positive than US earning estimates. So on a price to earning level, there could be more pain in European equities because valuations are actually not that cheap, given that the E part of the PE can still come down. But from an investor positioning level, it's extreme short.
How would you play this? You've got obviously one of the biggest paddocks of ETFs in the world. What would you do?
So when we look at ETF flows in this context, you know, it's been all about fixed income in the past month or so. We're seeing some signs of significant de-risking from investors. So one stat I'd share with you is of overall global ETF flows across the industry in September, 61% went into rates exposures. That's pretty safe haven to me, you know, and most of that has gone into the short end of US Treasuries. And, you know, the ETF industry is celebrating 20 years of fixed income ETFs this week, so quite a milestone here, and the industry has evolved a lot. But it's been all about fixed income and really safe haven fixed income in this environment.
So considering that, I think you have $3.5 trillion of ETFs in your stable. What kind of growth do you see for this industry? I mean, in a year when M&A has fallen apart. We've just seen the bond market kind of shut down. There have been no IPOs of note other than Porsche. There continue to be a ton of ETF launches. Does this growth continue, or does a recession slow us down?
So it's a great question, and I think I'll take it asset class by asset class. When we look at fixed income, as I said, you know, 20-year anniversary this week, the adoption of fixed income ETFs is on a rising level. And in fact, at BlackRock, we forecast that by 2030, the $1.7 trillion of assets sitting in fixed income ETFs today will become $5 trillion. So we see a lot more room for further adoption in fixed income ETFs. And in fact, during periods of market volatility, like what we've been seeing in the past few weeks, we see a go-to fixed income ETFs in terms of really increasing trading volumes and liquidity providing. Now, when we look at equities, I think, you alluded to this with the launches. I think we're seeing increasing focus on more precision type exposures. So whether it's at the level of more selectivity on a sector and factor exposure level, or whether it's on a thematic level, we're seeing more and more specific exposures that investors are going to play selectivity in equities.
Karim, thank you very much for joining us. Karim Chedid of BlackRock. Coming up on the programme, we will think about tighter monetary policy and its impacts on a different asset class. We'll talk about crypto. Tim Grant joins us, Galaxy Digital's head of Europe. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, an interview with Ed Morse, Citigroup head of commodities research. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Now, Bitcoin is falling along with risk assets today after a strong September jobs report re-solidified expectations for continued hawkishness by the Fed. Joining us now to discuss, Tim Grant, head of EMEA at Galaxy Digital. Tim, very nice to speak to you this morning. Let me ask you how cold the winter gets for crypto then, because, you used to look on the social feeds of the crypto community and see plenty of memes about money printing by central banks. Well, that money printer isn't quite whirring in the way it used to be. So how difficult does it get for crypto assets?
Well, it's a tale of an idiosyncratic crypto element and an overall macro element. I think what's been interesting this year, and you've commented on it a little bit already, since the beginning of the year, sort of a maturation of this asset class when it started to trade. Bitcoin traded, as all intents and purposes, like a NASDAQ stock. So I think that started to change the way in which the market looked at this asset class. You could see the institutionalization happening. It's not a retail asset class anymore. And so the macro backdrop is really affecting us just as it's affecting every other asset class, just as we've seen in your graph there. What does that look like going forward? How cold does this winter get? Well, I think it's highly dependent on the macro situation, the Fed, policymakers in Europe, policymakers in the UK. Now, idiosyncratic crypto elements, we've seen plenty. You've reported on plenty over the last few months. We think the leverage is out of this system now, for the most part. We don't see any massive shoes to drop. We saw a hack last week, yet another hack on a bridge. Will we see that kind of thing again? Probably. Will that really materially affect this asset class?
Okay.
No, I don't think so.
Okay, so a lot depends on the macro and on the regulation, and you've talked quite positively about the EU legislation that we've seen to this point, and maybe the US, maybe the UK are behind on this one. What is it that's attractive about what the European Union has done here?
Well, look, I think the EU's just made a huge step forward last week. Just Wednesday, the EU Council effectively locked in stone the text for what's called MiCA or MiCA, the markets in crypto assets regulation. Now, why is that so significant? 27 states across the entire 330 million population bloc have agreed finally, after a long time and a lot of uncertainty over when this would happen, on the text. And that means that roughly, towards the end of this year, early next year, we'll see that get ratified and go into the official register or official journal. And then in 2024, we're going to see the opportunity for anyone who's regulated in any state to do business across the entire state. Now, this changes dramatically for corporates and businesses who are in this space, the opportunity set. And I think it does kind of catapult a little bit beyond the US, which is still fragmented, still thinking a lot about it. The SEC and the different agencies over there are still debating what to do, and there's obviously a political element there.
Yeah.
Quietly, the EU has gone forward and created something that gives us certainty going forward.
Okay, Matt, jump in.
What happened to NFTs, Tim? I mean, non-fungible tokens were the hottest thing from musicians to Bored Apes, and the values seem to have just dived even further than the rest of the crypto space. Are they coming back?
Well, look, the NFTs, just like a lot of elements in this space, they go, there's boom and bust cycles. There was a lot of activity in this last year, as everybody knows. An awful lot of money flowed into the sector, a lot of celebrities getting behind it, and that always causes a little bit of energy in the space. Now, of course, that's deflated now. We've seen NFT prices in general go down pretty materially. What we're seeing, though, on the back end of this, and this is actually true in non-FT crypto markets too, NFT crypto markets, we're seeing institutional adoption. So we're seeing big brands, luxury brands come into the space. There's a lot of talk of the metaverse. We're in the collision of the metaverse and NFTs. And what we're seeing in the background is some projects that really, we believe, in the next couple of years are going to kind of bring this back to the fore, but with something a little bit more tangible, something that's more experiential, something that really touches the consumer in a different way. So yeah, we do see in the long run a more sort of constructive backdrop to the NFT story. Matt.
Tim, you've mentioned institutional adoption a few times now, how it is larger institutional players now in the space versus just retail as it was before. And I'm wondering if that may be why we have seen these assets so range-bound for months now. If you look at a chart of the Bloomberg Galaxy Crypto Index or just one of Bitcoin, I mean, for about 4 months since mid-June, it has been essentially a straight line with very little movement up and down. Do you expect that volatility will come back into this asset class, or is that institutional play there a stabilizer?
Well, look, I think it's definitively a stabilizer. And if you look at the chart that's up there right now, you'll see there was the material downswing we had around about the Terra Luna collapse. Interesting to note that when that happened, perhaps somewhat counterintuitively, we saw a big onboarding demand from big institutions, big traditional hedge funds, banks, asset managers, endowments, pension funds, and we're still working through that backlog of onboarding. Now, why would that be? You might think that as prices went down, they'd think, oh, hang on, let's step back. Well, no, they've been working on this for a long time. This is arguably a better entry point. So yes, you are seeing more institutional participation in the space. It has created a two-way market. I think also notable is the derivatives market, a real barometer of the growth of any asset class, is how significant the volumes end up being in derivatives. We're probably the biggest balance sheet in derivatives in the world for crypto derivatives, and we're seeing healthy two-way flow across the board. Now, that's growing. Let's not over-egg the pudding. That's growing. But in terms of volatility, back to where we started, depends on what we see from a macro perspective. And look, there's always that idiosyncratic component. But yeah, it's going to come back. And I think, look, we're seeing the hedge funds trade healthily right now. They're making money in the same way that they're making things like Frontier FX and Frontier Rates at the moment. It's very much the same idea.
Tim, thanks so much for joining us. Great having you in the studio there in London. Tim Grant, head of EMEA at Galaxy Digital, talking to us about crypto. Tune in, by the way, to Bloomberg Crypto. That's every Tuesday at 1 p.m. New York time, 6 p.m. in London. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
We have some breaking news out of Oslo, Norway. The Nobel Prize in Economics has been awarded to 3 individuals, one of them being former chairman of the Federal Reserve, Ben Bernanke. The other 2 winners are Douglas Diamond and Philip Dybvig, who have done work on bank runs and bank research. The 3 of them, Bernanke, Diamond, and Dybvig, have been awarded the Nobel Prize in Economics over that bank research. Very interesting to see a former chairman of the Federal Reserve winning this prestigious award, Matt.
All right, we'll continue to cover that. Of course, you're going to hear a lot about it probably from Tom Keene on Bloomberg Surveillance next, so stay tuned for more on the Nobel Prize for Economics. Now, in terms of banking, David Solomon once predicted Goldman Sachs would be a leader in retail banking like it is on Wall Street, but expansion proved expensive, and the bank is now reeling in those aspirations and the resources dedicated to the project. That's the topic of today's Big Take, which is a very big take on Goldman Sachs and Marcus. Bloomberg Sri Natarajan wrote the story and joins us now early. Thanks so much for coming into the studio, Sri. Great story. And yeah, I mean, I think people have been waiting years for Marcus and for Goldman Sachs' consumer effort to work out, assuming it would, because everything else they do works out, and it hasn't.
And that was the interesting thing, right? This is a bank that's been around since 1869. For much of its history, its prowess has been in dealing with hedge funds, in dealing with the big corporations and the big institutions. So when they decided to make the jump into Main Street, it was a big deal. It was a symbolic move, and everyone was curious to say how it would pan out. 5-6 years in, a lot of money has been poured into the effort. The results are not there just yet. And you can see in a moment of severe pressure, the bank is reeling in those aspirations and saying, maybe we did make a mistake. Maybe we did have to choose a narrower lane and try to make sure from that point on the business is accretive to returns. The way they went wasn't quite it.
So now they're trying to reshuffle things around and restructure. What will that ultimately look like?
Look, some would argue that what they're doing now is actually playing to their strength. Instead of going direct to consumers, instead of swarming the airways with jingles and hiring reality TV show stars to sell their product, they're actually saying, we will market this product through our wealth channel. We already have a workplace offering. You have access to some of the biggest companies and their workforces. Try and offer these consumer products among the bouquet of offerings you already have for them. That may be a better bet for Goldman Sachs than going direct to Main Street.
Sri, I'm sure you can chart the history of the retail offering at Goldman Sachs quite a few years back, can't you? And I remember post-financial crisis, there's a lot of emphasis on banks securing retail depositor bases. Have the arguments for really developing and investing in this side of the business, have they changed? Is that part of the rationale here?
No, that's a good question, because the one part of the consumer business that always had fans was the part of the business that was sopping up deposits. The high yield savings account in Marcus already has more than $100 billion in deposits. That's a good business because no one can argue against the fact that the bank needs a cheaper source of funding and a diversified mix of funding, and this is just it. So whether it's through the consumer deposits or their newfangled transaction banking business, which does the same with corporate deposits. So that argument hasn't changed. But the problem was they were trying to do too much at once, as they themselves acknowledge, and that is why they had to take a breath, restructure, reorient these operations, and hope that the detractors will go away.
All right, Sri Natarajan, thank you so much for waking up early this morning for us, and thank you for that big take. You can find it on the Bloomberg terminal as well as online. Now let's take a quick look ahead at what is coming up for the rest of this week. China markets are back open for business after a week-long holiday. Wednesday is going to be a busy day for the UK Prime Minister Liz Truss as she directly addresses her mutinous rank-and-file Tory lawmakers in an attempt to reassert her authority. We'll also be getting some GDP data. We'll be getting that crucial U.S. CPI data on Thursday. U.S. retail sales will be on Friday, as well as U.S. bank earnings kicking off on Friday. And on the subject of banks, Matt, of course, we just saw the Nobel Prize in Economics awarded to Ben Bernanke, Douglas Diamond, and Philip Dybvig for their research on banks as well as financial crises. And of course, that award coming out of Stockholm today, Matt.
Yeah, absolutely. We're going to focus in on that. Are we getting the Nobel Peace Prize today as well?
We got that on Friday.
Oh, we got that on Friday. Okay,
yes.
So all the Nobel Prizes, are we all done as economics? Does it round out the... We don't know.
I don't know the answer to that, but I do know that these three individuals will be splitting the prize for this year, Anna.
Well, it's very exciting.
It is.
It's very exciting for them, I'm sure. That is it for Early Edition. More surveillance is ahead. They'll have plenty more focus on the macro story. Bill Dudley, former president of the New York Fed, joins. Also, they'll keep across the geopolitics, the latest developments in Ukraine and Russia. This is Bloomberg.